Video I am going to cover in continuation with last class. So what we had discussed in last class. So clean price and dirty price was the last topic which we had discussed in last class. So now in continuation with last class I am continuing. So welcome to investment banking classes. So what we had discussed last means clean price means what, dirty price means what. Clean price means this is selling price excluding interest, and dirty price means what? Selling price including interest. So there is a concept, interest accrual concept. So when you want to minimum selling price, you need to add selling price plus interest accrued, whatever the interest accrued to the time. So for that time also we have one concept that we will discuss today, and we will calculate the interest accrual and we will add to that selling price. That is the concept, and for that purpose we have two prices, clean price and dirty price. So clean price means what? Excluding. So now you need to add. So for what we have taken the example, GST we have taken example, invoice selling price, invoice plus 18% GST, that is clean price. And if you have included in that 100 into 18 divided by 118, that is dirty price. That is a concept which we discussed in last class. So in continuation, for example, now I am going to discuss about one concept, like if sell price is 90 rupees, then it is clean price. If they told na that is clean price, then what will be the gain or loss? So there will be loss of 10 rupees. Normal price is 100 rupees. You are selling for 90 rupees, and that is then will be 10 rupees will be loss. Now I am telling free float means what? In any company there are two types of capitals. One, promoters, stakeholders, and other will be other persons. Others may be mutual funds, retailers, foreign institutions, DII, etc., etc., any persons. They may invest too. So promoters may subscribe 70% or 80% or 90% and more than 50%. Some cases maximum they hold 50% and above they will hold, and some cases more shareholding will be there for other persons also. So if you are entering into market, if you are entering into market, newly entering, which market you will enter? Will go for high owner's capital or high promoter stake or others more. So if absolutely you will choose a promoter stake where the high, you will choose that one. Why? Because promoters have some responsibility, some more holding, they will work for that company. If they do not invested in their business, then how can you trust that company? So trust, for the trust you need, for first promoter will invest in that money. So first that case, free float means who is invested by the other persons, they don't have free floating available. Now for example, any company is there, they are purchasing any debentures. So when purchasing debentures, you need to add interest receivable or interest accrued, we need to account, and when you are selling you need to recognize. So if you are buying the debenture, what the entry will be? So if you are buying means debit what comes in, credit what goes out. So first you bank, cash means going to bank. So debit side what? Asset. Debenture is a asset. You are investing in debenture means that is asset. So investment in debenture account, debit to bank account, first entry. And another entry you need to pass, which one? That interest accrued, whatever the interest you will receive na. So interest receivable account, debit to interest income. So you must show that interest income also, interest receivable account, debit to interest income, and in investment in debentures account, debit to bank account. These are the first entries which you, when you are invested in debentures, you need to account for general entry. And when you are selling that debentures, then what is the entries will be? First of all, what is the principal amount plus interest accrued, that is the minimum selling price. That is the minimum selling price. If you are selling that minimum selling price, you need to write like you are receiving the amount. So debit what comes in bank account debit to interest receivable to investment debenture. So asset, when the asset is created means when you are invested at the time of purchase, you are invested means it will create a asset, so asset will be debited. Now you are selling, so asset is going out means it will be credit side. So bank account debit to interest receivable to investment in debenture, this entry will be passed at the time of sale of it debentures. For this interest or debentures, you need to consider three factors. One market price, and one will be changing interest rate, and one will be changing credit rating or credit risk of the issuer. Why this required to need means money market price of any security, market price of any security can go up or can come down based on demand and supply. So always the market price will be depend upon demand and supply. Whatever the demand, whatever the supply, based on the demand and supply, market price will go up and market price will goes down. If more investor want to invest in one security, then demand will be increased. So when the demand will be increased now, price will also increase. So for demand and price there will be direct relationship, and for supply and price it will be inverted relationship. So DP, remember like a DP, so WhatsApp DP or Facebook DP, whatever you wanted. So DP has a direct relationship, so demand will increase, price will also increase. And for example yesterday that company IPO was went. If any company is traded at one price, for example some 100 investors to buy Infosys company shares at 1500 rupees. Now today there are 500 members want to buy that same Infosys company, then price will go up because there are more persons want to buy now, then they will trade it at high price. That is the first concept. So market price will be the same. So same way, based on the demand and supply, bond price will go up and reason will be increase in demand. Next, change in interest rate. So how the interest rate will affect change in interest. If interest rate are going down, or investors like old bonds, they are paying high interest. So now if interest rates are down, who are paying high interest rate on old bonds now, they will try to repay the amount. So then old bond price will go up. So old bond price will be go up. Now for example, if government issued one 10 years bond, for example 2015 to 2025, they issued one bond at 10 rupees interest and will pay 10% till 2025. So now in mid of year, that is 2020, that due to corona, the interest rate was changed, 7% is enough. So now whoever bond was issued 7% interest rate. So if any investor in the market, now they have only two options. So they buy new bonds issued by the government and get 7% interest, that is 7 rupees on 100 rupees investment, or buy old bonds issued in 2018, get 10% interest, so 10 rupees. So when the interest rate is decreased on new bonds, in old bond they have high interest rate, they will choose that old bond. So within old bonds demand was increased, that price also will be increased. Next, opposite way, if interest rates are now increasing, for example we have told that last year 10%, now 7%. If last year 10%, now it will be 12%. Now new bond price will be increased. Next, third one, change in credit rating or credit risk of the issuer. If company has huge losses, so whatever the investor, what they will do, if the company is in loss, how they pay. So what is the assets is there, what is the credit rating. So credit rating normally provided by this credit rating agencies, Credit or Moody or different. They will provide triple A plus or triple B plus. Based on that credit rating, you will see the how much risk is there. So how much they repay, how much doubt will have in a repayment. So they will sell the bonds based on that one. So now if the company reducing, now if you are a startup company, after 2 years or 3 years you are now reducing your losses and start making profits, ability to repay will increase, so the demand will increase and market price will also be increased. For example, in for company started making profit, ability to repay, so when they have the repayable capacity, demand will also increase, so then their bonds market price also increase. That is the concept. And once I told that interest accrual concept, in interest accrual we need to take the days up. So for days convention means number of days used in the period to accrue. For the calculation of interest accrual, you need to take days. Now for days we have days convention concept. In days concept conservation, popularly day conventions are act to act. Means act to act means what? Actually basis. Actually basis means what? For example, if you take the January month 31 days, February month 28 days, March month 31 days, April month 30 days. So actual to actual basis. How many number of days is there in that month, and we will take that number of days only. That is day convention act to act basis. In this case, for example, interest accrued, if you have an interest accrued for 3 months or 4 months, so you need to take an actual basis 31, 28, 31, 30, that type. If in so interest accrued for each month is different in this act or act day convention. So some cases they may provide that 30 days per month or total year have 360 days. Then you need to for take for January 30 days, February 30 days, March 30 days, and April also 30 days. And for full year you need to take 360 days. That is 30 by 360 for day convention. So in this case, all months are assumed to be same amount of interest accrual. That is the case. That is a day convention concept. So all months interest is same. In the day convention, more common method is act to act in industry. Depends on the debt issued related papers. This can be found out which day convention to use for that instrument. So if you are seeing now for that instrument, you need to see that papers how the date convention is there. So for that date convention you need to see, and accordingly you need to calculate. If it is a act to act basis, that is actual basis, you need to take the actual days of the month. If it is they are following some convention basis, that is 30 to 360 cases, so you need to take the all months 30 days only and yearly 360 days. That is the concept of first day convention cases. And for example, if that is learning, in next class we will take the continuation.